Cool.
Hey guys, welcome to the Syndicate, the show where we have the world's greatest investors. Today, I am somewhere totally new. I'm in Toronto. I have a nice new background, and I have someone awesome on the program, Jonathan Hakakian. He runs SoundBoard Angel Fund, and he's a pretty interesting guy. He's been helping me out with the Syndicate. I wanted to get on because he runs an interesting investment model for his firm. So thanks for coming today, Jonathan.
Thanks for having me on, Matt.
So I'd like to give everybody an opportunity to share their story. How'd you get here?
It is definitely not a linear story. About 10, 12 years ago, I had a beautifully failed startup. A friend and I, we started a company. We really hustled, tried to make it work, realized it wasn't, transitioned that business into a consulting firm. And along the way, I met my now business partner, Richard Magid, who has been running a consulting firm, has been working with much more mature leaders, much more mature organizations. We partnered together because we had this shared passion of working with early stage entrepreneurs and helping them grow and succeed. And after years of research and just collaborating together, we realized that there was an opportunity in the market back in 2012 to launch a fund. And that's really where the inception came, just a lot of hustle and trying and working with entrepreneurs in different ways.
You say fund, but you have an interesting fund structure. Tell me about it.
So our Fund One structure was very collaborative with all of our investors. We had 37 LPs, and it was pooled capital up front. But we really mobilized them to engage in the diligence and the screening and meeting with the companies, and they would vote on what we would due diligence on and ultimately invest in. So instead of it just being Richard and myself making all the decisions, we really relied on the power of the 37 individuals.
So you have all of these separate LPs. Are you guys creating SPVs then for every single investment?
So our Fund One structure was no, it was actually a fully closed fund with pooled capital. We do have an SPV structure as well, but that's a separate entity.
But today you run the Delaware series you were telling me about.
Yeah.
Why the transition from a fund to more of a deal by deal SPV?
So right now we are raising our second fund. We've been in the process for about less than 6 months on getting everything together, getting our documents aligned, our strategy. So we are going to transition back into a fund. But in the interim, because we had such an engaging and collaborative process where our investors wanted to be part of it, we knew that if we were to close up shop and go dark, our investors were still going to be active. So we wanted to provide that service to them where we were still bringing them high quality deal flow. We were still being the shepherd for the diligence process, but allowing them to invest in the deals that they wanted to. And so we have this network model, which is very unique. It's still highly collaborative, and it is in an SPV model, as you referenced. Yeah.
So you went from a fund to a syndicate to another fund. Why didn't you raise the fund two earlier? There's got to be a story.
So with funds, it's all based on track record, uh, and how active you are in the market. So Fund One has been very active, and uh, we've been around since 2012, so just about 6 years. 5 years from our first investment to our last investment, because our last investment was in September of 2017. But we're in really early stage companies. These are companies that are just past being born, just past infancy. You know, they're just past being out of their garage. And so the lifeline of the lifetime of these companies is getting longer. It's no longer flipping a company in 3 to 5 years. It's now taking 5, 6, 7, 10 years to realize those exits. And when we started building the strategy for Fund Two, we realized that, you know, in order to get to where we want to get with it, we need to make sure that we have the whole story in, that we are through an entire life cycle with these companies in order to raise what we want to and hit the goals we want. So we decided to do this network model just to continue the activity. We had such a good group in Fund One. Of our 37 investors, I'd say 20 or so are still active with us today. The others, some of them have moved out. Their lifestyle changes. They're no longer actively investing. But the majority of them are with us. They're strong, and they're showing up to our screening and diligence meetings regularly.
So when you say lifestyle changes, would that mean that most of your LPs are high net worth individuals or just solo angels?
Correct.
Okay. So how did you go about building that network? How did you go about building? That's something that everybody struggles with, is getting a large enough investor base to be able to build the fund. How did you guys initially do that?
We weren't very strategic about it. We looking back, it all just came together. But we didn't really know how to build a fund when we built it, to be honest. We were piecing it together and learning as much as we could by reading, by talking to other people who have built funds. But where we are today, I look back and I'm like, wow, 6 years ago, we knew nothing. So it was pretty amazing. But I will share that the first 15 or so investors were close friends, were family, were people who believed in Richard and me and what we were trying to do. And when we went out, we really just had a pitch deck, a vision, and a good network of entrepreneurs coming to us, and Richard's success in consulting with mature stage companies. So that was the first 15 or so. The next 5 or 10 were friends of friends, were connections, and were people starting to get excited about our vision. And the last 10 to 15 were just straight hustle, being out in the market, meeting people, connecting, and just building a good brand name.
And that's always how it works. And then you get the track record so you can raise the second fund.
Yeah.
Speaking of which, you said you just had a company acquired by Uber?
Yep. On Monday, it was announced that our fourth investment back in a company we invested in 2013 was just acquired by Uber on Monday. We're very excited about it.
What's your typical check size look like?
Our typical check size out of Fund 1 was anywhere from $50,000 to $150,000 from the fund, and then we saw a good sizable amount of follow-on investment from the investors individually. So our ballpark range could be anywhere from 50 to 300.
How does that work for you guys, where you have a fund and then you also have the separate SPVs? Do you get any type of carry on the separate SPVs?
We learned that lesson, that we needed to be part of that SPV process quickly. There's a good subset of side investments that we did not have a carry on. Once we figured out how to structure it, we have done it through the SPV model, and we do get a small carry there. The main benefit is that for us, because they're portfolio companies, or because even the investors met the entrepreneurs through SoundBoard, we were getting the calls and being reached out to for the follow-up contacts anyway. So we said, well, why don't we just streamline it? This way I have all the access, SoundBoard has all the documents, we know exactly what's going on, and we're the point of contact.
And tell me a little bit about your legal structure for that, because it's interesting, and I think people could learn.
For the SPV?
For the SPVs, the Delaware series.
So we've done a Series LLC model where each investment is a series underneath a master LLC. We did it this way to keep costs low. It is a bit complicated, I will say, but internally we do good bookkeeping, so we track everything.
And it basically equates to, you can set up as many SPVs as you want, and you only need to send out a single set of K1s to investors. Yes.
That becomes the simplicity. There's only one K1 per investor, even if they go across 5 investments.
This
is for all the side investment, by the way, not for the fund. The fund is a separate entity.
Which is very important when you're cutting checks that aren't enormous, that you can have as little as possible in terms of fees that are going to legal and accounting. And these are some of the challenges we have with the syndicate as well. We use a similar series model, thanks to Jonathan here. He was very helpful with that. How did you initially get started investing, though? So you said you had a startup, it failed, and then you started investing.
We had a startup. We transitioned that startup to working with other companies, both early stage and mature stage. And so we had a good idea of what it took to make a company run, what was needed for the hustle, what ingredients were there that makes the company succeed versus not. And so my partner and I, we we worked with a lot of them. And then, we parted ways. We then started our own careers in different industries. He went the financial route. I went more back into development, real estate, construction, contracting. And then along that journey, I met my partner, Richard, who had a prolific career on Wall Street in the 90s, and decided to jump from Wall Street and start his own firm in I think 2000. All around consulting, leadership development, management, building, retreats, executive coaching. And, like I mentioned, when we came together, it was for this shared passion of working with early stage companies and helping them succeed to their next milestones and their growth phases. Richard's consulting practice and his financial prowess, coupled with my network, my ability to talk to entrepreneurs, and then also our joint networks of investors, we just saw people coming to us saying, we're looking for capital, we're looking for advice, or we want to get into this game of venture capital, of angel investing, of startups. We're hearing all these buzzwords going on. We have capital, but we don't know where to put it. And we need somebody to help guide us in this angel venture capital landscape. So it was fortuitous at the time. We didn't intend on building a fund back in 2010 when we partnered, but over the course of the next 2 years, it became readily apparent that we were hitting on a nerve in what I'm calling a secondary ecosystem outside of the metro New York area. Our office is in New Jersey. We get deal flow from all over the Northeast, all over the country, but primarily New York and Philadelphia, but we'll look Boston down to DC, all the way to Pittsburgh will be our primary target. And we just hit this nerve where investors and high net worth individuals wanted to do something, but they didn't know how to get started. And we became that resource for them.
Any sector or thesis focus?
Everybody asks this question. We actually don't have an industry focus. And that's because of how collaborative we are with our investors. Because they're a part of our team, because we're engaging them in the process, in the screening process, in the voting process, in the diligence, and ultimately like, hey, should we invest or not? We can go really broad from an industry perspective, but we can't go very deep in terms of technical. We're not the deep science or the deep life science, biotech, deep tech, any of those focuses. We shy away from primarily because we probably don't have the industry expertise, number one. Number two, the entrepreneurs in those scenarios typically have trouble finding the business case when they come to a group like ours. They present the technology more than, hey, this is a solid business that's going to achieve revenues, break even, and then exit.
So I want to pivot the conversation a little bit. Sure. We were talking before the program. You've got a 6-month-old, and you've been working on raising Fund 2, I think you said, for the past 6 months. How is it building a venture capital firm while having a newborn baby?
It is not easy, although nothing's easy with a little one. It requires an immense partner from my wife. She's very understanding. And I have to say, our son is great. He knows that when I'm on the phone, he tries to stay quiet if I'm working from home.
At 6 months?
But at 6 months, he tries to stay quiet when he knows that I'm on the phone. It's not easy, and it never will be. The challenge here is more just work-life balance and making sure that I am a good partner, a good father, and when I'm home, I'm focused, not just working. But it is a challenge because I have to be out there fundraising, helping the portfolio companies that are in the first portfolio, and meeting new entrepreneurs to keep our pipeline robust, as well as just managing the day-to-day operations of the fund.
So for the fund, you've been raising for a little while now. What was your prep like in terms of raising the fund, meeting investors, getting things lined up?
We actually haven't formally started raising. We've been doing all the prep now. Yeah, no, and part of that is because of having a 6-month-old. But what we've actually done is over the past 6 months is we've gotten a couple of our processes set up. we have a very specific vision and mission for what we want to do because we're doing something so unique in the marketplace. We really want to make sure that it is fully rounded out before we go out to the investor community to make sure that, hey, they want to join this journey as well, because now we're going out to a much larger marketplace and asking for some larger checks.
What's your target fund size?
We're aiming for 20 or so.
Will that affect how you guys cut checks in terms of investment philosophy and what you're looking for?
In terms of stage, no. We really like this early stage market. So we like playing, in that sub 10 million pre-money valuation area, whether you want to call it seed, pre-A, whatever it is. That's kind of our focus. We're going to stay there, but we can play a stronger role, both in terms of check size, in terms of access, and then also in participating in future rounds. But we're going to stay focused on that size fund or size round.
Okay. And then is the goal to continue, typically the goal is to continue to build the fund and make larger and larger fund sizes just because of how the management fees and everything worked. Are you committed to being a micro VC forever, or is this something where you want to build $100 million, a $500 million fund?
The way I'm thinking about it is, at this point in time, it will remain a micro VC until we can solve the technological challenges of bringing a mass amount of people to collaborate together seamlessly. So
that's always fun.
Yeah, it is a challenge to bring people together, but we did it with Fund 1, and with Fund 2, we have a good process in place to bring people together. But once you go over a certain threshold, and that'll go with a larger fund, it'll prove to be difficult without bringing in the right technology experts. And we are an early stage fund, so I'm hoping we can find some companies to partner with to build it.
That or institutional LPs that just cut bigger checks.
They're always welcome.
Always welcome, right here. Jonathan's not fundraising, but if you want to talk to him, he'll buy you coffee. I want to jump to the lightning round. How's that sound, Jonathan? Speaking of coffee.
Let's go.
What is the first investment you made?
The first investment we made?
Mm-hmm.
Oh, boy. It was back in 2012, a company called Hire Next.
How's it going?
They were acquired by a faster growing privately held company called Procter U about 3 or 4 years ago.
Okay, not bad. So you got some type of return, I'm hoping.
It's privately held, so we own stock in a faster growing company, but we're still pretty proud of them.
Okay, good work. Two biggest wins?
Well, the company that was acquired by Uber on Monday is our biggest so far. Yeah.
That's what's that look like? So you're learning basically about what's happening somewhat from the media, just because I imagine it's under wraps a bit.
Very much so. Yeah, I don't have any details to share yet because nothing official has been given out, but there's a good amount of rumors that have been leaked, been dissipated, but I don't know what to believe yet. I do know that the deal has closed.
What'd the company do?
They were a bike share company. The original name was Social Bicycles, and now it was rebranded Jump Bike over the past 12 months. They did a pilot with Uber in San Francisco for electric bike share, 250 bikes starting from January, and the deal just closed for the acquisition on Monday.
Very nice, very nice. Who's number two?
Number two, these are tough questions. You can't ask these of a fund manager.
Transparency, my friend.
We have a lot of favorites. Hire Next is definitely one. I'll also mention another New York company called Seamless Docs. They've really done a great job in selling their product and have a great product that they fundraised for. We invested in him. He was our third investment back in December of 2012. Jonathan Endy of Seamless Docs, he came out of the Entrepreneurs Roundtable Accelerator here in New York.
Okay. I know they have a pretty good rep. What about anti-portfolio? Who have you missed?
Oh man, I haven't kept good track of that, but there are a lot of misses. I try not to dwell on it because when I look back, when we have the misses, and I think of where we were at that time, usually there's a good reason on why we passed, and most of the time it's that we weren't a fit for that group, for that entrepreneur,
Okay.
not the other way around.
Well, that's better than feeling terrible about it. What are you excited about today? What gets you pumped up? Industries, businesses, etc.
What gets me pumped up? I still think that there's a lot that's going to happen in IoT, in the home, in the car, and very, very soon, the wearable technology, but within clothing that's integrated into the everyday life. I think a lot's going to happen there. We're starting to see what it really looks like, but nobody's really leading on the clothing side.
Any bold predictions? 10-year time frame?
I mean, the boldest will be the whole autonomous cars, but I think we're going to have a lot more in the home that's taking over and tracking, and the home is going to change much quickly, or very quickly, over the next 10 years.
Because your little Roomba's not going to kill you on accident.
Well, my 6 months old is very, very much afraid of the Google Home we have.
Oh, I could imagine that would be terrifying. What's other than ICOs, what's overhyped?
What's overhyped? All buzzwords. I don't care what buzzword you use. They're all overhyped. ICOs, blockchain, VR, AR. There's great technology there, but when somebody comes and their first slide starts saying that they're just throwing out those buzzwords, it's an immediate turnoff.
Okay, I like it. Where do you go to daily, weekly basis to stay informed? Podcasts, blogs, newsletters, the good stuff.
Just talking to people. Honestly, I'm not the best at catching up on news. I listen to my world news on NPR. Tech news, it's whatever hits the inbox, and just staying informed through friends and colleagues. Fortune's term sheet is probably the best one out there in terms of a blog.
Okay, term sheet. We'll throw links in the show notes if I remember. We'll see about that. Jonathan, I know you're super busy. You got the 6-month-old. I need to go and grab coffee incredibly much. Where is the best place for people to find you online, reach out, tell you if they have good investment opportunities, or better yet, if they're LPs and want to invest in the fund?
Twitter is always a good place. Handles at JHAKA, at JHAKA. But my email's online. There's a contact form on the website. I am very accessible. Just don't send 4 pages in the email. Send something that will get the attention and solicit a response.
Short teaser, nice, exciting,
exactly,
prompt, and why it matters for him and not every single person out there.
Yeah, dear investor letters don't get answered.
Yeah, dear investor letter. Oh God, the LinkedIn's always rough as well. Yeah. Thanks for coming on today, Jonathan. Is there anything you want to leave people with?
No, this was great. I appreciate the tough questions and making me think through the portfolio.
That's what I'm here for. That's what I'm here for. Guys, go say hey to Jonathan. If you haven't already, subscribe to the Syndicate, thesyndicate.vc/iTunes. Leave us a review if you want to be an incredibly awesome person. And I hear Elon may actually send you one of his nice new Teslas for free. Now, I can't neither confirm nor deny that report. So obviously this is not anything illegal, but it would be very nice if you left a review. Until next time, guys. That was weird, me saying so many things and not turning it off. So we're going to turn it off. Cheers.
Thanks, Matt.
Cheers, Jonathan. Let me stop the broadcast.